Hi friends, we shall take up a problem on statement of cash flow as done in Ind AS 7 alongside of consolidation. That means it is a consolidated cash flow statement that we will be doing, and it is picked up from our CA Institute study material illustration number 12. So it is a complete approach. Why is that? We are going to see that it is a complete approach. In Institute study material, that is through illustration number 12, the question was only on finding out cash flow from operating activity, and the question by itself running to 2 pages and a small portion in the third page, and the question by itself a little incomplete and some inconsistent information that you have. So a little big and incomplete and inconsistent data that they have provided. So why I have chosen that particular question for our discussion is that students should not feel that it is a tough problem, it cannot be approached, and they will try to bring out the same answer as what institute is providing. So when you just have a complete approach by taking up investing activity and financing activity, we will be in a better position to understand how the answer provided by the institute is a little incomplete. So sorry to see that, but we have to accept fact. We have to call spade a spade, and let us just know about how to proceed. So in this process, we will go through the illustration, which I have put it in one slide. We will read that with greater care. So in order to bring the file size to be less, I will hold the question for some amount of time. So when you watch that in YouTube, you pause and read it, right? And I will be discussing based on the question. Okay, reading the question is going to take more time. I will read it out, but I will convey what is it we should do with that particular adjustment in the cash flow statement. That is, in the statement of cash flow, how a particular adjustment will be impacted. So I will not read it out. I will have a pause for 4-5 seconds. That is the time at which you can also pause and read it out. Then follow the lectures where I will be explaining each one as how you got to approach. And then through the PPT in the following slides, I will explain as how we have to create working notes and how they will impact our cash flow, and we will not address not only cash flow from operating activities, we will take up investing as well as financing, and our answer will be perfect. And all those inconsistencies and incompleteness and the errors that they have just put into the solution were all rectified, and you will have a better grasp on the subject. So that gap is filled now. So I'm not there to see that somebody is wrong. There was some gap and the gap is filled. Okay, that should be the spirit. Now let's just go through that. This being the paragraph, I mean the institute study material items. So where you can just read it out with greater amount of care. I will pause for some amount. Okay, now let us just take up. The question is about where they have given you the information in a consolidated financial statement of A Limited, which they have provided, and from there they are asking us to prepare consolidated cash flow. So the year is ending by 31st of March X2, and beginning is 31st of March X1. The first item that we read it out is property, plant and equipment. It is 4750 and at the opening it is 4650. So what we need to look at is immediately go to this particular stage where they given the breakup as opening balance 4650, then additions 800, revaluation 80, disposal 490, yes, and a depreciation 290, and you have 4750 as the close. And if you look at adjustment number 2, they said 100% subsidiary they have acquired, that being Yes Limited for 300 lakhs, and in that you have property, plant and equipment to the extent of 140 there. But if you have to include this 140, your closing balance will not be 4750. It should be 4890. So that means when you have opening balance and the closing balance, with nothing they have mentioned about property, plant and equipment of that 140 from subsidiary company. So though at the time of acquisition the fair value they have mentioned as 140, but it is not found in the consolidated balance sheet, we should only be understanding that they have written off this 140 that they have written off, like depreciation and impairment. So we are expected to add back. This will not result in any outflow of cash. So this is one important information which you don't find it in the solution provided by the institute. Let me repeat. We have opening balance of PPE at 4650. You have addition made during the current period, revaluation conducted, disposal made, and you have depreciation, but they are not included the subsidiaries figure of PPE. So where this PPE would have gone? That means when they have not explained, we should only understand that they have written off. So therefore, in statement of cash flow, especially on operating activities, to profit after taxation or before taxation as the case may be, you got to add back like depreciation this item also. Have that in your mind. Okay. The next item is investment in associate 800. So investment in associate 800. For that, if you look at adjustment number 4, where they mentioned something like they purchased at the year beginning and at what value they have purchased, they have not mentioned. And during the current period, the associate reported 400 as the profit and they have declared dividend to the extent of 100. So what this parent would have done, the parent would have taken up this under equity method. What is that they would have done in equity method? For the increase in the profit of 400 lakhs, they would have applied 30% of that. So that will come to 120. And for the dividend that they have declared, that being 100, on to that if you apply 30%, there is going to be a reduction in the investment value by 30 lakhs. So 120 lakhs you increase and 30 lakhs you decrease. There is going to be 90 lakhs net increase, which is included in the figure of 800. So in 800 you have this 90 as the net increase. So that means the opening balance is nothing but the cost at which they bought, that being 710. So what are the care that we are going to take up? So when we prepare investment activity, cash flow, statement of cash flow of investment activity, under PPE, we are expected to take up that 800, the purchases. And the revaluation has got to be taken up as part of your OCI. So that is only a book entry. So that is not going to impact your cash flow statement, but that is a relevant information when you prepare for a balance sheet, because the balance sheet what they provided is incomplete. They are given up to liabilities, up to trade payables, and what had happened for their borrowings and their other equity and the equity capital they have not mentioned. So we are going to build something which is not complete. We are going to build a separately working notes for that. So under that OCI, this 80 will be coming up. So the purchase of an asset, that being 800, disposal of that for some profit which they mentioned as 630 lakhs, that is going to be a receipt of money, and the cost at which they have shown the disposal of 490 and here 630, there is going to be a gain to the extent of 140. So that 140 amount, that being the gain, is impacted in your current year's profit. So we are expected to deduct that, because that amount of gain is included in the current year's profit, so which is not coming through your operating activity. So therefore, alongside of the sale of that PPE, it will be finding place in investment activity. So we will have purchase of PPE and OCI 80 will be taken up there separately. Sale of PPE will be taking up, and investment made in associate, that being 710, will also be reported within brackets, that being the outflow. So this is what you got to take care of. Financial assets. So financial assets 1800 at the beginning and 2150 at the end. What is this? So what is this financial asset? This is a sort of a receivable that you have. It could be a lease receivable. So that receivable beyond your operating cycle will come under that particular item. So very much this matter could be related to your operating only and not related to investing or financing. So therefore, the increase that took place during the current period, that being 350, has got to be taken up under statement of changes in working capital as part of your operating activity. So as how we will take up for changes in inventory and trade receivable, same is the case we have got to do. But in our institute material, when they have suggested the solution, they did not take care of this. That is the reason as why I told you it is incomplete, and when it is incomplete, we will be believing that as the correct answer. But when you find our solution, you will come to know that institute missed out this 350 to be taken up as part of our statement of cash flow on operating activities. Okay, so have that in your mind. The next item, that being inventories, you have 1900 at the beginning and at the end 1550. This acquisition, that is, I mean, when subsidiary companies inventories were all taken into account, you have PPE 140 we are talking about, and then 60. So this 60 is very much there in your closing. That is what we will be taking up, or you can add it to your opening and then bring out a comparison. So we have developed a separate working notes for inventories, trade receivables and trade payables, taking into consideration what they have taken from subsidiary for consolidation, and the same got compared with the opening, so as to find out the changes in inventory, trade receivable and trade payable impacting the cash flow as resulting in inflow or outflow. So have that in your mind, and that has got to be given your due care. And regarding cash and cash equivalents also, when they got the subsidiary company into their fold, there you are having 20 lakhs. The figure of cash and cash equivalents here would not only be including the parent's item, but also subsidiaries cash and bank balance also. So here is a place where you got to be very careful. So the parent company paid 300 lakhs, and in that it is 20 lakhs they have got the cash. So how we have made changes for inventory, trade receivable and trade payable and financial asset. Same is the way for cash also you got to bring about some change. What is the change that you got to bring about? So it is something like I pay 300 and take 20 would mean the net result is only 280 I paid. So that is the way we should look at. So though I paid 300, but I have included 20, which from subsidiary company I have included. So the net effect is that I paid only 280. So therefore in our cash flow statement under investing activity, we will be taking up 280 as investment in subsidiary. The net of 300 what we have paid and 20 what we have taken. So that's the way we will be taking up, because both are cash. So when you pass a journal entry like in Ind AS 103, when you are acquiring a company, you have a debit of cash, and pay also cash would mean you can set off both the debit and credit by a net amount. That is what I am trying to communicate on that. That is the place where you got to be very careful. And by looking into the acquisition, there is the goodwill that is resulting is only to the extent of 100. So there I am not taking up 280 minus 200, that is going to be 300 minus 200. When I acquired, we have acquired it for 300, and here it is net worth at that point of time is 200, and there is no question of non-controlling interest that you have. So 100 should have been the figure somewhere here, and we do not have this goodwill at all. And at a later point of time, they said goodwill impairment loss here, and here I put this way. The goodwill impairment is with respect to 100% subsidiaries. So here is a place where there is an inconsistency, is what I was just telling about. You paid 300, then worth is only 200, 100%, no NCI. The entire 100 is the goodwill. So how much you would have impaired is only 100, and what they just mentioned is 265 is not correct. So we have got to add back only 100, like depreciation, whatever whatever we just take it up as impairment, and all that write-off of PPE, that 140, like, alongside of that we will take up only 100. And they went on to tell intangible assets impairment loss. See, there was no impairment loss at all. There was no intangible asset at all. You have PPE, and next item investment in associate and financial assets. So this figure of 900 is not related to that. So therefore I am ignoring this 265 also. I am taking up only 100. So when you prepare statement of cash flow for operating, I will add back only 100. So have that in mind. These are the inconsistencies that you have. Then we were talking about A spent 30 on renovation of building, and the entire item was charged to P&L account. This is a mistake that they have committed. So therefore what we will do is that a renovation which they did not capitalize, but they have put it under operating, so which requires a rectification, add back to your net profit, and take it up to investing when 30 is to be taken up as an outflow. So add back 30, like a mistake that you have committed. So to that extent your profit is reduced. Your profit should have been much greater, add back. And since this matter is related to investing activity, put it under investing activity. So adjustment number 1 over, 2 over, 3 over, and in adjustment number 3 itself there is something like they have incurred some construction cost of 40 which they have charged to other expenses. So on the same lines only, so add back 40, that capex, and the same will be shown under investments. By mistake they have taken up a capital expenditure as part of revenue expenditure, and to that extent your profit is reduced. Add back 40 and show it on the outflow of cash under statement of cash flow of investing activity, and that's the way we are expected to take up. Then the next one is that of that interest cost of 110 lakhs charged to profit and loss account, 10 lakhs included towards specific borrowing, that has got to be capitalized. So in your profit and loss account 110 that you have, so you are expected to add back 110, because if this information of capitalization of borrowing cost is not given, what we would have done is that 110 we would have added to our net profit under statement of operating activity, and the same 110 will be shown as outflow under financing activity. Here what we are expected to do is that for 10 lakhs alone, it is to be taken up under investing activity. Only 100 has got to be taken up under financing activity. So what we are expected to do is add back 110 to your net profit and show 10 as outflow under investing, show 100 as outflow under financing. That is what we are expected to do. So 110 delta, where 110 added, shown 10 under investing and 100 under financing. So therefore 110 is fully dealt. So adjustment number 4, in this, that 120 what you have for share of income, which increases your investment value and increased your profit, and they have shown profit to the extent of 120. So if you ask a question whether cash will result or whether you have an actionable claim on the associate, answer will be in the negative. You will not get that money. You do not have actionable claim on your associate. So just to follow equity method, we have added the investment value and added our that is profit and loss account. So when you are not likely to realize, but you have shown it as part of your income, reduce it. You will never be getting it. So reduce from your profit 120, and what is that we are expected to do? This 120, which will not have any impact in your other activities, simply ignore. So what we are expected to do, to the net profit you deduct 120. That is what you are expected to do. Whereas the dividend what you received from your associate is a result of or the dividend what you have received is something associated with your investments made. So therefore that will be shown as an inflow under investing activity. So have that in your mind. So when you are doing it, and adjustment number 5, as I told you, 265 and 900, I will take it up only for 100. So and here I just wanted to put everything in one page. So therefore I have used a tool and put all this, and question is very well discussed. Now we are going to take up in the next slide manuscript only. Now let us just go through that. Now how do we go about? Now whatever I have explained, I have put it in my writing, and we have just done that work. Opening 4,650, purchases 800, and a revaluation 80, disposal and depreciation 490 and 290. So here is a place where I wanted to tell that 140 which is missing, that has got to be taken as written off. So this is sum and substance. So whatever lectures that you have listened, understanding the question, now you find it out in the form of the working notes. Now the second one is about investment in associate. So investment in associate which is there for at 800, now increase that took place during the current period, and that is on account of earning, that being 120 that I told you, on account of dividend that is going to be 30. So for this 120, no cash flow is involved, whereas in this particular case cash flow is involved, but this did not this particular item did not affect your profit and loss account. So you reduce your investment, increase your cash. So that is what you have just done. This 30 has got to be taken under investing activity inflow. So because of that you can take up the net as this cash flow is present and the net is going to be 90. So when you deduct this 90, the opening balance is going to be 710. So this will result in outflow of cash as investment in associate. This will come under investing activity. Now let us just take up for inventories, trade receivable, trade payables and financial assets. So now let us just go through as how these numbers will be impacting our cash flow. Closing balances we have taken up from the respective positions, and then we have deducted on account of consolidation, because in consolidation we would have added no. So that particular addition is not required because we have already paid for that. Then deduct the opening. When you do that, the net result what you have is the change, and as far as inventory is concerned, it is 410. So from an opening figure of 1900, the closing figure is 1550. Taking into consideration subsidiaries figure as well as the opening 410, there is a decrease. Decrease in this particular case will result in inflow of cash. Next one also the same, 590. Trade payable, you have 2110. In this particular case, a greater payable to a lower payable, this results in outflow of cash, right? The next one, as far as financial asset is concerned, this is what institute had just completely ignored. That is why I told you, incomplete presentation where you will not know whether you are in the right side or on the wrong side. And if you have gone through the earlier illustration, institute had just made a point that changes in financial assets is on account of operating activity. When nothing is mentioned, by default you have to take it up under operating activity only. So that 350 from a lower figure to a greater figure would mean you have invested, so therefore it results in outflow. Now let's just go through this particular point, closing and then opening. So what is it we have? Assets. When you have an incomplete balance sheet, how do we take it up? So 15,150 and 13,700. So if my video is um, blocking your vision on what we have written, I will remove that. So just don't worry about that. Liabilities and OCI, PAT and the balancing figure is going to be debt and equity. So if I deduct liability both at the beginning as well as at the close, what I get is generally to be considered as equity. Under that you have OCI, you have PAT. By doing that, you end up with debt and equity as 11,680 and 10,090. From 10,090 it had just gone up to 11,680. How much is the amount of inflow they would have got? We are not knowing as whether this inflow is only on account of equity or only on account of debt. So therefore there is an increase in debt and equity to the extent of 1590 that you would be having. So that is what you are going to have. And now let us just proceed to the last slide, that is last working notes in fact I would say, and cash flow from operations, and we have cash flow from investing and cash flow from financing, and we have just divided the page even in the notebook. When we just manually do, I will do in this fashion only. Profit before taxation 1840, add back depreciation and amortization 290. Amortization I have not taken up what institute had just provided. I have taken up only the goodwill, that being 100 there. Then PPE written off to the extent of 140, renovation to the extent of 30, then capex of 40 that we have to take up, interest of 110 that we have got to take up, then the gain has got to be deducted, that being 140, share of income of associate 120, which will not result in the form of inflow of cash, that we have deducted. So changes in financial assets, inventory, trade receivable and trade payable, all that we have seen as a working there in the previous page, and now by taking up all that it comes to 820. This is what you have to take it up. The question basically in the institute material, they've asked only from operating activity. The operating activity answer is 820 only. There is no intangible asset. You do not have a very high goodwill, because they have given the information of how they have bought. They have put very clearly cash 300, the net worth is only 200. There is a difference to the extent of 100 alone. If that be the case, how they could have amortized such a great figure, that is not explained there. So therefore our answer is the best possible answer for that incomplete question. So a purchase of PPE 800, as I told you, sale of PPE 630, then comes investment in associate 710, then purchase of subsidiary 300 you paid, 20 you have taken as a cash, 280, renovation 30 resulting in outflow, capex of 40 outflow, capitalization of interest in, and thereby we are expected to take up the only item dividend received, that being 30 there. 1290 you have as the outflow in the case of financing activity, investing activity, financing activity, raising of equity or the debt. 1590, this is the one that I was explaining, and interest payment to the extent of 100, because I told you 110 has got to be divided into 2, and 1490 is the net cash inflow. Increase in cash and cash equivalent is 1100, that is explained as 820 minus 1210 plus 1490. Opening cash and cash equivalent being 3550 and the closing being 4650, and that's a way we have made a safe landing. Okay, I hope that you people can just go through once again, and you will definitely appreciate as how best we can develop the solution within the shortest span of time. Okay, all the very best, and we will see in some other lectures on FR. Thank you. Please do forward to your friends who are in need. Okay, thank you.